Good morning, ladies and gentlemen. My name is Novena Mulyadi. I'm from EMBA class IPMI International Business School, September 2021 batch. This is my corporate finance class mind mapping by Prof. Roy Sambel. Every decision you make in business has a financial consequences. And let me start. Number one, financial management. Goals of financial management, how to manage corporate finance, good corporate governance, principal agent problem, and 4 cornerstones of corporate finance. Second is about capital budgeting. It's about cash flow and methods. Number 3 is security analysis, fundamental analysis, technical analysis, equity, preference, long-term debts, return earnings. Number 4 is about capital structure. It's about equity, debts, return earnings, optimal capital structure. Number 5 is about corporate restructuring, financial distress, survive and transformation the business, restructuring corporate structure. Number 6 is about fraud risk management, unethical versus illegal concept, the whistleblowing, fraud triangle, perceived pressure, opportunity and rationalization, occupational fraud and abuse, corruption, asset misappropriation, and prudent statements. Number 7 is about international finance, foreign exchange market, forward future option, arbitrage, locational, triangular, and interest rate. And number 8 is about market efficiency, international finance, market efficiency, capital market, and why company pay dividend. For financial management is an optimal orchestration of internal and external financial resources towards significant and sustainable value creation. The goals of financial management is in order to achieve significant and sustainable value creation. It consists of 4 objectives. Number 1 is basic objective, operational objective, social objective, research objective. All of them towards significant and sustainable value creation. How to manage corporate finance? There is 8 tools. Number 1 is about capital structure, working capital management, asset structure, revenue management, cost management, cash flow management, growth management, risk management. And then about good corporate governance, there are 5 principles: transparency, accountability, responsibility, independency, and fairness. All of them lead to prudent management according to mandate given, sustainable performance improvement, better corporate image, and value creation. What about principal agent problem? Principal agent problem is a conflict in priorities between a person or group and the representative authorized to act on their behalf. An agent may act in a way that is contrary to the best interest of the principal. So there will be information asymmetry that involving moral hazard and adverse selection. Number 5 is about 4 cornerstone. There are core of value principle, conversation of value principle, expectation treadmill principle, best owner principle, all of these for value creation purpose. Second term is about capital budgeting. Capital budgeting is the process a business undertakes to evaluate potential major projects or investment. Plan or big investment in an outside venture are example of project that will require capital budgeting before it was done. Number 1, we should analyze the cash flow, initial cash flow, periodic cash flow, terminal cash flow, and the method we could use payback period, net present value, profitability index, and IRR. Consider all cash flow, time value of money, and required rate of return. Capital budgeting concept used to estimate expected future cash flow, evaluate the project based on capital budgeting evaluation criteria, decide whether which project is good or bad. 2 or more projects can be mutually exclusive, may choose one only, or independent, may choose all good projects. The third one is about security analysis. Security analysis is a method of evaluating the intrinsic value of an asset and analyzing the factor that could influence its price in the future. Number one is fundamental analysis, domestic and global economic. Industry analysis, company analysis is about financial statement analysis, profitability, liquidity, activity, leverage, and market ratio. DuPont system is used to summarize key relationships which determine the overall performance of the firm, so we can decide more clearly. Intrinsic value versus market price. Intrinsic value calculated by the investor. Basically, it is discounted future CF. Market price is consensus value by market participants. Decision is if IV more than MP, then buy. IV below MP, sell or short sell. IV equal MP, hold or fairly price. Number two is technical analysis. It's about equity, preference, long-term debts, and retained earnings. Momentum versus reversal, trend up and down, support and resistance, gap, common breakaway, triangle, asymmetric, symmetric, double bottom, double top, moving average. Technical analysis is a trading discipline employed to evaluate investment and identify trading opportunities in price trends and patterns seen on charts, like the example below. And then security analysis. What is the concept of portfolio theory? The modern portfolio theory refers to an investment theory that allows investors to assemble an asset portfolio that maximizes expected return for a given level of risk. The theory assumes that investors are risk-averse for a given level of expected return. Investors will always prefer the less risky portfolio. So portfolio theory is concerned with total risk as measured standard deviation. Portfolio measures the risk of all assets held in a portfolio. CAPM measures the risk of individual security or asset that will be added into a portfolio. How does beta relate to CAPM? What is beta? Beta is a measure of the volatility of systematic risk of a security or portfolio compared to the market as a whole. Beta is used in the capital asset pricing model, or CAPM, which describes the relationship between systematic risk and expected return of four assets, usually stocks. This is about capital structure. Capital structure refers to the specific mix of debt and equity used to finance a company's assets and operation. Equity represents the value that will be returned to a company's shareholder if all of the assets were liquidated and all of the company's debt were paid off. Return earning is the amount of net income left over for the business after it has paid out dividends to its shareholders. A growth-focused company may not pay dividends at all or pay very small amounts because it may prefer to use the return earnings to finance expansion activities. Debt. Many corporations and individuals use debt as a method of making large purchases that they could not afford under normal circumstances. Corporations issue debt in the form of bonds to raise capital. Optimal capital structure. An optimal capital structure is the best mix of debt and equity financing that maximizes a company's market value while minimizing its cost of capital. Factor that determine is tax benefit and expected cost of financial distress. So there has to be balance between debt and equity. A company can have, in order to minimize its cost of capital, the rate it pays to use more money and maximize its market value. For conclusion, the company must find an optimal capital structure that minimizes the cost of financing and minimize the risk of bankruptcy. Corporate restructuring is an action taken by the corporate entity to modify its capital structure or its operation significantly. There are two types of corporate restructuring: is financial restructuring or organizational restructuring. There are also 5 different forms of corporate restructuring: is merger and acquisition, divestment, debt restructuring, cost reduction, and legal restructuring. The outcome of financial distress is there are 2: turnaround opportunity. The outcome of financial distress is there are 2: turnaround opportunity. The outcome of financial distress is there are 2: turnaround opportunity. The outcome of financial distress is there are 2: turnaround opportunity. The outcome of financial distress is there are 2: turnaround opportunity. The outcome of financial distress is there are 2: turnaround opportunity. The outcome of financial distress is there are 2: turnaround opportunity. The outcome of financial distress is there are 2: turnaround opportunity. The outcome of financial distress is there are 2: turnaround opportunity. The outcome of financial distress is there are 2: turnaround opportunity. The outcome of financial distress is there are 2: turnaround opportunity. The outcome of financial distress is there are 2: turnaround opportunity. The outcome of financial distress is there are 2: turnaround opportunity. The outcome of financial distress is there are 2: turnaround opportunity. The outcome of financial distress is there are 2: turnaround opportun consisting of operation, asset, financial restructuring that might lead to bankruptcy or private walkout. And there are permanent problems that consist of liquidation and bankruptcy. There are several processes of integral financial distress, from early impairment, deterioration of performance, cash flow problems, failure, default, insolvency, and then lead to bankruptcy. Then the company should survive and transform the business from stop the bleeding, financial restructuring, temporary pivoting, strategic aligning, redefining core business, and new ways doing business. The last one is about restructuring corporate structure. There are 8 moves. The first one is capital structure, lower debt to equity ratio, working capital management, asset restructure, revenue management, cost management, cash flow management, growth management, and the last one is about risk management. Fraud risk management, simply put, is the process of assessing fraud risk within your organization and developing an anti-fraud program that stops any fraudulent activity before it happens. There are fraud triangles, perceived pressure, opportunity, and rationalization. How to prevent fraud? We should build employee ethics, write SOP that have to be followed if fraud event is suspected, discovered, or identified. Train employees to increase alertness for fraud and how to prevent fraud, including financial control procedure, IT security, etc., protective security, hardware and software, and create whistleblower mechanism. What kind of fraud that usually happen? There are corruption, asset misappropriation, and fraudulent statements. The whistleblowing is an act of reporting misconducts to managers, executive, or other authorities with the power to take correction. 2, to empower employees to identifying wrongdoing and to protect the integrity of the organization. Dividend debate. Should publicly listed company pay dividend or should it allocate for capital investment to gain more profit? There are dilemma, financing. What should the return earnings for? Number 1 is to financing profitable capital investment or paying dividends to stakeholders. If we pay dividend to stakeholders will receive an immediate cash reward for investing, but the capital gain will decrease since this cash is not invested in the firm. What about if we return earnings for profitable investment? Dividend yield will be 0, but the stock price will increase, resulting in a higher capital gain. There are factors that are affecting dividend policy. Funds liquidity, past dividend rates, earning stability, debt obligation, investment opportunities, control policy, shareholder expectation, past dividend risk, company's financial policy, impact of trade cycle, borrowing ability, legal restriction, corporate taxation policy, government policy, and divisible profit. International finance is the study of monetary interaction that transpire between 2 or more. There are 2 types: foreign exchange market that consists of forward future option, and arbitrage, locational, triangular, and interest rate. Foreign exchange market allow currencies to be exchanged in order to facilitate international trade or financial transaction. Has evolved from the gold standard to agreements on fixed exchange rates to a floating rate system. Forward market enables a multinational company to lock in the exchange rate at which it will buy or sell a certain quantity or currency on a specified future date. Locational arbitrage is capitalized on discrepancies in exchange rate across location. There are types of triangular arbitrage, covered, and interest arbitrage. Market efficiency refers to the degree to which market prices reflect all available relevant information. What is market efficiency? That is, price reflect all variable information. Those financial asset prices are fair price. They are neither too high or too low. What is meant by all available information, historical data trading, publicly available information, and all private and public information? Information set of market efficiency, there are three types: strong form, semi-strong form, and weak form. Implication of efficiency is future market price cannot be predicted based on available information. So it should be a random walk. Investment in this market have a zero NPV, net present value. The expected rate of return equals the required rate of return. The expected rate of return compensates the investor for the risk borne. Abnormally high returns are earned by pure change. Strategy in an efficient market. Diversify, select suitable asset allocation. Don't try to time security price movement. Keep tax consideration in mind. Passive investing, index fund, dollar cost, and averaging. Thank you. That's all my mind mapping for corporate finance class. Hope it suits you well.